Rave's surge looked unstoppable until supply concentration. Exchange transfers and squeezed shorts revealed how controlled the whole move may have been. The pressure point is simple. Concentrated supply, exchange flows, and a short squeeze created a dangerous Rave setup. RaveDAO RAVE Red is the search phrase, but the immediate question is where the next break or failure actually sits. The tension here is simple. The loudest claim is not always the part with the strongest proof. RaveDAO went from roughly 25 cents to nearly $19 in less than a week, a move above 6,000% that immediately raised questions about how much of the rise was organic demand. The chart move is dramatic, but the deeper issue is whether the market underneath it was ever broad enough to support ordinary exits. That gives the story a hard anchor before sentiment starts doing the storytelling. The analysis identifies supply concentration at close to 90% in just 3 wallets, giving a tiny number of holders the power to shape both price and liquidity without broad market participation. In easy English, concentrated supply means too much control sits with too few wallets, so price can move without broad demand. This is where structure matters more than surface excitement. For people typing RaveDAO RAVE Red, the next useful step is to separate what is already operating from what is only being promised. Around $42 million of Rave reportedly moved to exchanges during the rally, then got withdrawn instead of sold, which helped trap short sellers and fueled a squeeze as forced buying pushed price even higher. That detail is often where the risk moves from theory into actual exposure. The mechanism is a low-float squeeze. If supply is concentrated, spot buying can move price quickly. If shorts crowd in early and the expected dump does not arrive, liquidations become forced market buys that extend the rally and hide how fragile it is. For traders searching KW, the important distinction is between a bounce created by mechanics and a recovery supported by healthier ownership and liquidity. Once that mechanism is visible, the pricing story gets easier to read. That setup is dangerous because it can punish both sides at different times. Early shorts get squeezed. Late longs buy the illusion of strength. When the incentive to keep price elevated fades, the unwind can be violent because so little real depth exists underneath. When slippage gets extreme, a token can keep showing a price while many holders can no longer access anything close to that price, size for size. This is why users, traders, and treasury desks can react very differently to the same headline. The open question is whether any real demand base exists once the squeeze dynamics cool. Stabilization would need broader participation, not just internal support or one more reflex bounce. Watch ownership concentration, funding rates, and exchange inflows. If those metrics stay distorted, the risk is not just volatility. It is a market structure that can be turned on and off by a very small set of wallets. The uncertainty is part of the valuation, not a side note after it. That is why RaveDAO RAVE Red ends with one hard test: whether the next move comes with healthier liquidity and cleaner structure than the last one. When a token breaks this way, the chart is only the surface. The real question is whether the market structure beneath it ever deserved the confidence it was given. Once the noise is stripped away, follow-through is the only thing that can confirm the pitch.